We're coming out of a year where the Fed held rates for the majority of 2025. They're now signaling a very shallow easing path into 2026. Deeper cuts? The markets are still flirting with the idea, but the Fed's own projections are now more cautious. Joining us from Spain, Daniela, market analyst at Capital.com, to unpack what this really means. Danny, great to have you on the show. How would you summarize what's going on at the moment, and where do you think the Fed would be positioned ahead of the next FOMC meeting?
Hi, Ricardo. Well, that is the key question, and that's what's been driving a lot of the volatility in markets. And I think because we've had a little bit of a data void with that blackout that we've had in the US government, markets are kind of flying a little bit in the blind. So the question really is, it depends who you ask. If you're asking markets, they seem to be pretty convinced that the Fed is going to cut rates at their meeting next week. Roughly about a 90% chance priced in. If you're asking the Fed, I don't think maybe they're as sure about that, and it could be more of a 50-50 layout there. So it's really a question of what's been driving these expectations and what exactly the Fed is going to do at the meeting, and that divergence or discrepancy is what's going to drive a lot of the volatility in the coming days.
Got you. And it's fair to say that recently we've seen the US dollar have a very brutal year, continues to trade under pressure at the moment, given the economic indicators pointing to a possibly slowing US economy. What could you tell me about the dollar? Is it potentially going to struggle to maintain any upward momentum?
Yeah, I think, look, the momentum over the last few weeks goes back to this kind of expectations about where monetary policy is going to go and how that's going to affect yields and the dollar moving forward. 2025 so far, up until pretty much the last quarter of the year, has been a move away from the dollar driven by a debasement trade and driven by concerns about the fiscal environment in the US and how it's unsustainable given the new policies that have supposedly being introduced by the Trump government. So a lot of the trade in 2025 has been about that. Now, looking at the last quarter, we've seen that recovery driven mostly by expectations that actually the Federal Reserve was not going to be as dovish as expected. The easing path was not going to be as strict heading into 2026. And now, once again, we're starting to challenge that and taking away the optionality from the Federal Reserve to potentially not cut rates at this last meeting of the year. So again, the dollar is going to be very, very sensitive to the change in expectations and to any messaging around the Fed and also the latest data that we have coming out.
Much appreciated, Danny. This is a great segue to the next topic, all the way from Australia, senior market analyst at Capital, Kyle. Always good to have you. Recently, gold prices rose strongly on the back of that decline of the US dollar we were just talking about, and renewed expectations that the US Federal Reserve will potentially still cut interest rates this year. What do you see? Do you see this as a healthy trend? Pauses, early stages of a potential new gold era? What do you see, my man?
I see still very constructive fundamentals for gold. I mean, if you sort of outline, what I've kind of described as the 5 factors for gold throughout 2025, you're talking about monetary policy, also threats to Fed independence going forward. There's fiscal conditions across the globe. US trade policy throughout the year has been a very strong driver. And there's also been geopolitical risk, of course, because of the issues in Eastern Europe and the Middle East as well. Some of those factors have diminished a little bit throughout the year, but I think what's really driving gold going forward is what I would describe as the run at hot trade. Like you noted, interest rate cuts, and Danny noted as well, of course, interest rate cuts being priced in, not just in the United States, but around the world, but chiefly in the United States. You could see the federal funds rate at around 3% next year. But on top of that, rate cuts that are coming on in an environment of still elevated inflation, and with what I would argue are upside inflation risks because of the absolute deluge of fiscal policy or fiscal spending that we could see from the US government, but also governments in Japan, or the government in Japan, as well as major governments in Europe, chiefly Germany as well. So effectively, and going back to that kind of notion of a debasement trade, precious metals is very much of this expression of very, very deep fiscal spending at the same time as interest rate cuts. And for me, notwithstanding a fairly overbought market on a technical basis, still augurs very well for the outlook for precious metals and gold in particular.
Sounds good. I just want to capitalize on silver. Obviously hit a few headlines this year, continuing to push to fresh all-time highs. What can you see a path potentially to $60, $62 area? What does that look like?
Certainly could. I mean, I'd say just off the top that there is a sort of a concerning development there in the gold-silver ratio, which has fallen to about a 4-year low, which sort of raises the question about whether silver's run too far ahead of itself and that maybe we're on course for a bit of a correction. However, what I will say is that there's a bit of a double whammy when it comes to demand for silver. First, goes back to that precious metal discussion that we've just had. But the other element that's worth remembering here is that a lot of this government spending around the world that is raising fears about, economies running too hot is for money that's being earmarked for projects tied to semiconductors, electrification, as well as the broader AI infrastructure. Governments are embarking on this for both economic and strategic reasons as well. And those products are all things that have silver as a very significant component. So you've got that precious metal play, but then you've also got that industrial metal play as well. Of course, coming at a time where there is still issues around production across the globe for silver. So again, there does seem to be some technical indicators there that raise sort of alarms for me that maybe silver's priced in a lot of this good news, but nevertheless, there is still that very strong demand impulse, not just from the precious metals complex, but also the industrial applications of silver.
Sounds good. Really quickly, talking a little bit about all this macro noise, the Magnificent Seven, still printing and flirting with all-time highs. Is this mainly about AI earnings power or just lack of alternatives?
There is both of that. I mean, one reason why you could sort of point to US outperformance, maybe even US dollar outperformance into the new year as well, is that effectively US tech remains one of the few drivers of safe and reliable earnings growth into the future. It has to be said, though, there are very high expectations still set for a lot of these companies. 26% earnings growth for some quarters into 2026, which of course raises that question about return on investment and whether that kind of growth is going to materialize. But nevertheless, I mean, US tech remains the really powerful growth engine in global equity markets, and I don't think we've seen a reversal in that trend just yet.
Thank you for your time, Kyle. David Jones, a regular here at Capital. I'd like to continue on that all-time high narrative with the S&P and NASDAQ in focus. How much of that is genuine broad strength?
Not much, I think, is the quick answer. It's definitely been exaggerated by the Magnificent Seven. There's an interesting index, the S&P equal weight index, where every component has an equal weight. And absolutely, it's up on the year, the trend is up, but it is quite interesting if you compare it to the S&P 500 that we all watch. There is a difference there. So we are seeing, quite the skew in indices this year. Look at the NASDAQ since the April lows. NASDAQ 100 is up about 50% since those April lows. That's a heck of a move in, under 8 months. So we are seeing a distorted market. But of course, that doesn't mean it can't stay distorted for many more months to come. There's a great saying that bull markets climb a wall of worry. We saw markets really hit in April of this year, March, April, because of the tariffs, massive sell-off. And again, the perma bears saying, well, this is it. This is the top, down we go for years again. But we've seen these markets bounce back strongly. AI has been the concern over recent months. It's a bubble. Can it go much further? Well, the answer that markets are giving us so far is that yes, it can go much further. Just in the last couple of weeks, we've had fresh all-time highs. So the trend is absolutely up. We need to be aware of the skew in the market. But there's always a worry somewhere, isn't there? I think as investors, as longer-term investors, people are always looking over their shoulder and thinking, right, where's the next crash coming from? AI is the big worry for now. But I think, these markets are still strong at the end of 2025. And if we've seen anything, during the past year, it's how resilient they have been following that sell-off due to the tariffs. So overall, still positive. It is an odd market, but I think if you look back over the last 25 years, when has it not been an odd market? There's always something, whether it's the aftermath of the financial crisis, the dot-com bursting in the early 2000s. There's always something a little bit odd going on in markets. So I don't think this is any different.
I hear you. And I just want to turn to the other big macro barometers here, oil and natural gas. Do you see this as a range market?
It's been weird, if you look at oil during 2025 and then you compare it to markets like stock markets or silver, gold, oil looks really boring, and it's quite rare that we say oil has had a boring year. But actually, if you look at the range, it's ranged from about $55 to $80. So we're still seeing a decent range for oil. But there is very little excitement in that market at the end of 2025 and in recent months. If you look back over the last 6 months, it's a wide sideways range. If you took a bigger picture view over the last few years, back to the Russian invasion of Ukraine that pushed oil up above, I think, about $130 a barrel, we're more than half that now. So the broader trend for the last 3 years has been down. I think there are concerns about global economic growth. We've had the battering from various tariff decisions this year that has made economists nervous about how strong global growth could be in the years ahead, and I think that is something that's weighed on the oil price. So overall, again, I think going into 2026, I think we are going to continue to see something of a rangy market. 55 for now, 55 seems to be something of a low point for oil. So I think from a trading point of view, perhaps we'll see continued interest if there is weakness into that zone. But overall, it has been a rangy, slightly downward year for oil. And in the short to medium term, I don't see much that's going to change that.
Thank you, David. Finishing up in Europe and zooming in on the German market. Joining us from Germany, Herman. What can you tell us about the sectors you're watching right now?
Yeah, good morning all together. In Germany, we have right now a very, very tricky situation. We have a political situation, actually. We don't know right now if we have on the end of the year still a government. On the first view, it has nothing to do with the market. Right now, the market is still very high. We have a plus in Germany 40 here on the platform from Capital.com, 0.2%. We are lightly under 23,800 points. But the big point is on Friday, the German Bundestag will vote on a pension bill. And some of the younger members of the parliament do not want to approve it. So the risk there is that the coalition will split off on Friday if this new law will not pass the parliament. So in case that the coalition is split off or the government collapse, then we have two possibilities. We will have, how do you call it, minority government or new elections, and this could have a huge impact of the European Union. Because on the second point, we discussed in Germany that there should be the end of the combustion engine ban from 2035, because the German industry suffers a lot. We lost 300,000 industry jobs in the last few years. The social costs are going up. So that could have a very, very big impact what traders and investors doesn't price in right now. We could see maybe a big surprise on Friday, what could shake everything up.
I hear you. And what can you tell me about the German DAX at the moment?
The German DAX is still pretty strong. As I said, we are light between 23,800. From my point, I would say we are waiting really for this week, because we can't change governments this year anymore. And then we will see how the investors will react on the situation if we get back up over 24,000 or if we crash down.
Much appreciated. Thank you for all the analysts. That's it for today. We look forward to seeing you next time.